Welcome to the deep dive. It's kind of surprising when you think about it. Even with all the tech buzz, iBuyers,
Mhm.
those companies making quick online cash offers for homes, they only handled about 1% of U.S. single-family home sales back in 2022.
Yeah, just 1%. And what's even wilder is that one company, Opendoor Technologies, basically had like 79% of that small slice.
Exactly. It's this huge disconnect, isn't it? A supposedly game-changing way to sell, but still just a tiny fraction. Makes you wonder.
It really does. Disrupting real estate is clearly harder than it looks.
Which brings us right to our focus today. Opendoor Technologies, tickers open.
Hmm.
As we're talking, May 8th, 2025, the stock's hovering around, what, 87 cents? Super low.
Right. So we've gathered a whole bunch of data analyst takes, financials, news, you name it.
And the big question we're tackling is, at this price, is Opendoor a hidden gem, a value opportunity? Or is it, potential trap? Especially with these new 2025 U.S. tariffs shaking things up in the housing market.
That's the mission for this deep dive. We're going to really unpack Opendoor, look at the business itself, check its financial pulse, see what the market mood is.
And figure out if, right now, it's compelling or maybe something you'd want to, approach with caution.
Precisely.
Okay, let's start at the beginning then. For anyone maybe less familiar, what exactly is this iBuying model that Opendoor, pioneered?
Okay, so iBuying, in simple terms, is about offering homeowners speed and convenience instead of the whole traditional listing hassle.
Agents, showings, waiting.
Right. Companies like Opendoor use algorithms, data, to give you an instant cash offer online. Click, click, offer. It bypasses almost all that traditional friction. Opendoor was really out front, trying to make selling a house almost like, well, an e-commerce transaction.
So they buy your house quickly.
Yeah.
But that's not the end of it for them, is it? What's the next step?
No, that's just step one. Once they own the house, they usually do some work on it, necessary repairs, maybe some light renovations. Then the goal is to put it back on the market and sell it, hopefully for more than they paid, plus the renovation costs. They earn money on that difference, the spread, and also from service fees they charge the original seller.
Fees that are meant to be similar to traditional agent commissions, right?
Yeah, that's the idea. Competitive fees, but with the added benefit of speed and certainty for the seller.
So buy, fix, sell. That's the core loop. But you mentioned they've added more strings to their bow.
Oh, absolutely. The core iBuying is still central, but they've been smart about adding other ways to make money. Back in 2019, they launched Opendoor Home Loans.
It's mortgage services. Makes sense.
Exactly. And around then, they also bought OS National, a title and escrow company, so they capture more of the transaction value.
Yeah.
But the really interesting shift more recently is stuff like List with Opendoor and their marketplace.
Right. List with Opendoor Marketplace. How do those fit in? Are they moving away from just buying houses themselves?
It's a major strategic pivot, really. They're aiming to be more than just the buyer. They want to be a platform. List with Opendoor means if you don't like their cash offer, you can still use their tech and platform to list your house traditionally.
Ah, so they still capture the lead.
Precisely. And Marketplace takes it further, potentially connecting sellers with partner agents. The huge advantage here is monetizing leads they used to lose. Get this. In 2024, over 70% of the homes they eventually bought came from sellers who initially said no to the cash offer.
Wow, 70%.
Yeah. So these new models let them make money from that massive group, even if Opendoor doesn't end up buying the house directly. It's less capital intensive for them, less inventory risk, and it unlocks revenue from like the vast majority of people who come to their site. It's a fundamental shift.
That does sound smart. Less risk, more income streams. So who's the ideal customer here? What's the pitch to sellers and buyers?
For sellers, it boils down to speed and certainty. Need to sell fast? Don't want the hassle. Here's a cash offer. Done. For buyers, they get often renovated homes, maybe a smoother, more digital buying process.
But there was that issue with the FTC, wasn't there? Back in 2022.
Yeah, we definitely have to mention that. The Federal Trade Commission settlement, they were accused of misleading sellers about how much money they'd save compared to traditional methods. It raises flags about transparency and, well, past practices. Definitely something to keep in the back of your mind.
Good point. Important context. Now, where are they actually doing business? Is this a nationwide thing?
As of Q1 2025, they were in 50 markets. 50. Spread across the U.S. They say their setup is scalable so they could expand further, but being in that many markets means they're exposed to lots of different local housing conditions.
Okay, that paints a good picture of the business. Let's shift to the folks in charge. Who's running the show at Opendoor?
The CEO is Carrie Wheeler. She stepped into the role in early 2023. Her background's interesting, spent over 20 years at TPG Global, a private equity firm. She was actually Opendoor CFO before becoming CEO, and on the board too.
So she knows the company inside out.
Seems that way. Since taking over, her big push has been towards, profitability and evolving that platform strategy we just talked about. Lots of emphasis on discipline, efficiency. She's also the chair of the board now.
And the rest of the C-suite. Any recent changes or key people?
Yeah, there have been some notable additions fairly recently. Salim Freha came in as CFO in November 2024. He's got experience from Alphabet, Google, eBay. Big tech background. Could be very valuable.
Definitely.
Sydney Schaub has been chief legal officer since late 2022. She came from places like Gemini, Rent the Runway, Square Block. And Srisha Radhakrishna also joined in November 24 as the chief technology and product officer. His background's at LegalZoom, Intuit QuickBooks specifically. Again, strong tech platform experience.
So quite a few key leaders are relatively new then. What about the board itself? Any standouts there?
Well, besides Wheeler as chair, you've got John Rice as the lead independent director. Adam Bain is on there, co-founder of O1 Advisors, used to be COO at Twitter, knows scaling tech.
Right.
And David Benson joined in September 2024. He was president of Fannie Mae. That's obviously very relevant experience for the housing and mortgage side of things.
Okay. So when we look at management, a key question for investors is always alignment. Are their interests aligned with shareholders? What's the read here?
It's a bit mixed, you could say. On one hand, the public statements, the focus on profitability, the cost cutting, that all sounds like alignment. They want to build sustainable value. Executive pay often includes stock RSUs to incentivize that.
Right.
But you can't just ignore that FTC settlement. Even if it was about past actions, it happened. And some current leaders were around then in senior roles. So it raises questions about, well, past judgment or culture maybe. Plus, with several top executives being relatively new, their long-term track record at Opendoor is still being written.
You mentioned CEO Wheeler. There were reports of her selling stock. How should we look at that? Is it a red flag?
You have to look closely at the filings. Yes, she has sold shares. But the filings often indicate these sales are planned in advance, under what's called a 10b5-1 plan, specifically to cover the taxes that come due when her restricted stock units, those RSUs, vest. That's pretty standard practice for executives.
Okay, so not necessarily her losing faith in the company.
Not necessarily, no. And you also have to balance that against the fact she was granted a large number of new RSUs, 1.5 million of them, just in March 2025. That's a long-term incentive. Plus, her overall holding is still significant, something like 13.5 million shares as of March 25. That's nearly 2% of the company.
Yeah.
So she still has a lot of skin in the game.
Got it. Context is key there. Right, let's talk capital allocation. Big topic for any company, especially one like Opendoor. How have they managed their money?
Historically, they fueled their growth with, well, huge amounts of venture capital. SoftBank was a big name, General Atlantic too. Then they went public via that SPAC merger in late 2020.
Right, the SPAC boom.
Exactly. They made that strategic acquisition of OS National for title escrow. But fundamentally, their model requires massive amounts of capital, mostly debt, to buy all those houses. As of Q1 this year, they had access to almost $8 billion in borrowing facilities, asset-backed stuff, with about $2.1 billion drawn down.
That's a lot of debt tied to houses.
It is. And they did recently extend some of those credit lines, pushing maturities out to 2026 or later, which helps the near-term picture. But alongside that borrowing, we've seen major cost-cutting drives. Layoffs in late 22, early 23. A formal cost program started late last year. They did report a 33% year-over-year drop in fixed operating expenses in Q1 25, which is significant.
Okay, cutting costs, managing debt.
Yeah.
But what about the return on all this capital they've deployed? You mentioned ROIC, return on invested capital. How does that look?
Yeah. And this is frankly where it gets pretty ugly. Opendoor's ROIC has been consistently negative, like deep in the red. It was minus 12.7% for 2024, trailing 12 months ending May 2025, still around minus 12.5%.
Negative 12%.
Yeah. And you compare that to their estimated cost of capital, their WACC, which is probably somewhere between, say, 9.5% and 11%. When your return is below your cost of capital and negative on top of that,
Yeah.
you're essentially destroying value, not creating it.
Oof. That's not good. So they're spending money to lose money, essentially.
In terms of return on investment, that's what the numbers suggest right now. It's a major red flag for any value-oriented look at the company.
So given that grim picture, has their capital strategy changed? What are they doing now?
Definitely seems to be a change in tune. The mantra now is profitability and sustainable growth. They're talking about being much more disciplined about which homes they buy, adjusting their offer prices, widening the spreads based on market conditions.
Trying to build in more margin.
Exactly. And they're investing in the platform side marketplace. List with Opendoor those less capital-heavy revenue streams, optimizing marketing spend, continuing to hunt for cost savings, and importantly, no share buybacks, no dividends. All focus is on fixing the core economics and getting to profit. It's a pivot born out of necessity, given the tough housing market and their financial track record.
Okay, that's a clear picture of the business, management, and capital strategy. Let's dive into the hard numbers now. Financial health. What did Q1 2025 look like?
All right, Q1 25. Revenue came in at $1.2 billion. That was actually down 2% compared to Q1 last year, but it was up 6% from the previous quarter, Q4 24.
Okay. Down year over year. What about homes sold?
They sold 2,946 homes,
Okay.
again, down slightly year over year by 4%, but up 4% sequentially from Q4. So big signals there.
And the all-important profit figures. Gross profit margins.
Gross profit was $99 million. That's down quite a bit from the $143 million in Q1 24, but it is an improvement from $81 million in Q4 24.
And the margin percentage.
Gross margin landed at 8.6%. Compare that to 12.2% a year ago, quite a drop. But again, better than the 7.4% they saw in the previous quarter. Contribution profit, which is a metric iBuyers watch closely, was $54 million. Also down year over year, 63 EPS, but up sequentially 37 EPS.
So some sequential improvement, but year over year, the core profitability looks weaker. What about the actual bottom line? Net loss.
Still losing money, yes. The GAAP net loss for Q1 25 was $85 million. Now, that is better than the $101 million loss a year ago, and also better than the $139 million loss in Q4 24.
So the loss is shrinking.
It is shrinking, but it's still $85 million down the drain in 3 months. On a per-share basis, the trailing 12 months GAAP loss is about 56 cents, and Q1 was a loss of 12 cents. Adjusted EBITDA, another non-GAAP metric they report, was also negative, minus $30 million. That was actually worse than both the year-ago quarter and the previous quarter.
Okay, losses continue. What about inventory? That's the heart of the beast for them. How many homes are they holding?
Inventory levels are up. At the end of March 25, they held 7,080 homes. That's a big jump from about 4,900 homes a year prior. The value of that inventory is around $2.4 billion.
Holding more homes. Are they buying more too?
Yes. They purchased more homes in Q1 over 3,600 than they did in Q4 24 or Q1 24. So inventory is building. But here's a number that catches the eye. 27% of their homes for sale had been on the market for more than 120 days.
27% over 4 months. That sounds problematic.
It's definitely a concern. While that 27% is slightly better than the 30% in Q4, it's way up from just 15% a year ago. Aged inventory is costly.
How so?
Well, the longer you hold a house, the more you pay in holding costs, insurance, taxes, utilities, maintenance. Plus, the longer it sits, the more pressure there is to cut the price to sell it, which eats directly into your margins and potential profit. That iBuyer model really relies on turning inventory over quickly.
And with the new tariffs potentially increasing renovation costs and maybe slowing things down, that aged inventory figure could get worse.
That's a distinct possibility, yes. If renovations take longer or cost more due to tariffs on materials like lumber or steel, or if the tariffs contribute to a slower market overall, that 120-plus day inventory could definitely increase. It highlights the sensitivity of their model to these external factors.
So looking at the loss reduction, it seems maybe driven more by those cost cuts we talked about than by fundamentally selling homes more profitably.
That seems to be a fair assessment based on the Q1 numbers. Revenue was down year over year. Gross margin was compressed year over year. The improvement in net loss appears heavily influenced by lower operating expenses. And relying just on cost cuts isn't sustainable if the core unit economics making money on each house flip aren't strong, especially, as you said, with tariffs threatening to push up the cost side of that equation.
Right. Okay, let's broaden out to overall financial stability. Balance sheet health. What are the key ratios telling us? Cash, debt, equity.
As of March 31st, 2025, cash and equivalents stood at $559 million. That's down from $613 million at the end of 2024, so cash burn is evident. Asset-backed debt, primarily financing that inventory, was $2.1 billion, slightly down from $2.2 billion 3 months earlier. But stockholders' equity took a bigger hit, dropping to $645 million from $730 million at year-end 24.
Equity shrinking, debt still high. What does that do to the debt-to-equity ratio?
It pushes it higher. If you calculate it using total liabilities against that shrinking equity base, you get a ratio of around 4.08x as of Q1 25. That's up from roughly 3.7x at the end of 2024.
Over 4 times more liabilities than equity. That's pretty highly leveraged, isn't it?
It is, yeah. It signals significant financial risk. Most of their assets are tied up in that $2.4 billion of real estate inventory, which isn't exactly liquid. While renewing those credit lines helps buy them time, management themselves call it a significant debt burden. Liquidity is definitely something to watch closely here. Continued losses will keep eating into that cash pile.
And how do the 2025 tariffs specifically pressure this financial picture, beyond just the renovation costs?
Well, those increased costs directly hit gross margins and cash flow, obviously. But persistent pressure there could make servicing that $2.1 billion in debt harder. And think about their borrowing capacity. It's often tied to the value of their homes. If tariffs contribute to a market slowdown or force them to hold inventory longer, it could potentially impact their borrowing base calculations or increase financing costs. Their equity cushion is already thinning out because of the losses. The tariffs just make the whole financial situation feel, well, more precarious. Achieving profitability and maintaining lender confidence are absolutely critical.
Okay, a challenging financial picture, no doubt.
Yeah.
Let's pivot to how the market is viewing all this. What's the general sentiment out there towards Opendoor?
It's really quite divided. You see it clearly in the analyst ratings. The overall consensus is a hold. But when you dig into individual analysts, the opinions are all over the place.
Hold means
Yeah.
wait and see. Neither bullish nor bearish.
Pretty much. But the range of price targets is huge, which signals a lot of uncertainty. For example, Business Insider looked at 19 analysts. 7 had buys, 11 holds, 1 sell. Their median price target was $3.45.
$3.45. That's way above the current price.
It is. But then TipRanks, looking at 9 analysts more recently, had only 2 buys, 6 holds, 1 sell, and their average target was much lower, $1.36. TradingView data showed targets ranging from $2 all the way down to 68 cents.
68 cents below the current price.
Exactly. And we've seen some recent downgrades or target cuts too. Citi apparently has a $1.80 target. UBS cut theirs from $2 down to $1.20. So you have this weird mix. High average targets, but a cautious hold consensus, recent downward revisions, and a stock price that's below even some of the lowest targets. It screams uncertainty.
Definitely mixed message from the analysts. What about short sellers? Are people betting against the stock?
Oh, yes. Short interest is high. As of mid-April, over 80 million shares were shorted. That's up from about 70 million just a couple weeks earlier. The days to cover ratio was just under 2.
So a lot of negative bets out there.
A significant amount. It shows strong bearish sentiment, likely focused on the debt, the cash burn, the model's viability. But, high short interest also means if something positive happens.
Potential for a short squeeze.
Exactly. It adds another layer of potential volatility.
What about the options market? Any clues there?
Options market is also a big contradictory. If you look at the overall put-call ratio based on open interest, it sometimes leans slightly bullish. But if you look at recent trading volume, especially in near-term options, it's often leaned bearish, more puts being traded than calls. And implied volatility is sky high, over 100%.
Meaning the market expects big price swings.
Precisely. Big moves, but maybe not sure which direction.
And wrapping up sentiment, what's the vibe from recent news coverage?
Well, the Q1 earnings report got a lot of attention because they beat expectations on EPS and revenue. That caused a nice little stock pop. But most articles quickly pivot back to the same underlying worries. The debt, the cash burn, the thin margins, the tough housing market, and now these tariffs. Even with the earnings beat bump, the stock is still way down over the past year to date. You see headlines asking, is it a bargain or a trap? Some commentary suggests maybe bankruptcy isn't an immediate risk, say, for the next couple of years, but it's definitely framed as a high-risk, potential high-reward kind of situation.
Okay, so the market is definitely grappling with the story here. High risk, high uncertainty seems to be the theme. Now let's look at who actually owns Opendoor. Any big players?
Yeah, looking at institutional ownership from early 2025, the biggest holder by far is the Vanguard Group. They hold almost 12%, 11.78%.
Vanguard, usually index funds, right? Passive investors.
Largely, yes. BlackRock is the next biggest, with over 7%. Then you have names like T. Rowe Price, Renaissance Technologies, American Century, each holding around 2.4, 2.5%. So significant institutional presence, but often driven by broad index inclusion rather than active bets, especially for Vanguard and BlackRock.
What about insiders? People running the company.
We mentioned CEO Kerry Wheeler's stake earlier, about 1.87%, roughly 13.5 million shares, plus those recent RSU grants. For detailed holdings of other execs and board members, you typically look at the company's proxy statement.
And we talked about Wheeler's sales being mostly for taxes. Any other insiders selling recently?
There has been some, yes. The chief legal officer, Sidney Schaub, had multiple reported sales in Q1 and early Q2 2025. Again, you have to be careful interpreting sales. They can be for many reasons. But when you see consistent selling from multiple insiders, and importantly, not much significant buying on the open market at these low prices, it can sometimes dampen market sentiment a bit. It raises the question, if the stock is such a bargain, why aren't insiders loading up?
That's always the question, isn't it? Actions speak louder. Okay, let's try to pull all these threads together. A SWOT analysis, strengths, weaknesses, opportunities, threats. What does that look like for Opendoor right now?
Okay, let's lay it out. Strength. They are the market leader in iBuying, no question. High seller satisfaction scores, suggesting the core service works well for those who use it. They have proprietary tech, data analytics, significant scale across those 50 markets, a big database of leads, and they have made progress on cutting costs recently.
Okay. Weaknesses. Seems like we've hit a few already.
Definitely. The big one, consistent net losses. No proven path to sustainable profit yet. Heavy reliance on debt, that negative ROIC we discussed, destroying value. Very vulnerable to the housing market cycle, ongoing cash burn. Brand awareness outside iBuying is probably still low, and that FTC settlement still lingers as a reputational issue.
Right. Opportunities. Where could they go from here?
Well, expanding to new markets is always an option. Diversifying revenue further with the platform, mortgages, title, that's key, maybe deeper partnerships with traditional agents. A housing market rebound would obviously be a huge tailwind, and continued tech improvements, maybe more AI, could boost efficiency.
And finally, threats.
Yeah.
This feels like a big category for them.
It is. A prolonged housing downturn is threat number one. And right alongside it, we have to put the 2025 U.S. tariffs, increased material costs, potential hit to demand if it impacts affordability, maybe forces them to widen spreads so much they become uncompetitive. It hits them multiple ways.
Yeah, those tariffs seem pervasive.
They really do. Then there's competition, other tech brokers, maybe even new iBuyer entrants eventually. Regulatory risk is always there, especially after the FTC issue. Access to capital markets could dry up if financials don't improve, a general recession hitting housing, and just basic execution risk. What if the platform strategy doesn't take off as planned?
It really underscores how much depends on the housing market and now these tariffs.
Absolutely. Management themselves called the housing market extremely challenging recently. Mortgage rates over 7%, clearance rates down, delistings up. And the tariffs just add another layer of cost and uncertainty on top of all that. It makes that path to profitability look even steeper.
Okay, so synthesizing all of that. If we try to apply, say, a classic value investing lens, like Buffett's tenets, to Opendoor at 87 cents, how does it measure up? Understandable business, favorable economics, good management, sensible price.
Let's see. Understandable business. The basic concept, yes, buy and sell houses, but the execution, the tech, the platform pivot, it's complex, and the model is still evolving. So maybe partially understandable, but with lots of uncertainty.
Okay. Favorable long-term economics.
Right now, no, there's no clear moat or durable competitive advantage. It's a tough, cyclical industry. The ROIC is negative, the tariffs are a new headwind, so economics look unfavorable currently.
Able and trustworthy management.
The team is relatively new at the top. They say the right things about profitability and discipline. Wheeler has significant holdings, but the short tenure and the shadow of the FTC settlement make it maybe a wait and see on trustworthiness for some.
And finally, sensible price tag.
The price, 787 cents, is obviously low in absolute terms, but is it sensible? Given the huge risks, the lack of profitability, the negative ROIC, the debt, the tariff impact, it's really hard to argue there's a clear margin of safety here. The intrinsic value is incredibly difficult to determine and could well be lower.
So putting it all together,
It looks much more like a high-risk speculative turnaround situation than a traditional value investment opportunity today. And those 2025 tariffs are a significant negative development, making the turnaround challenge even harder.
okay, so with all this analysis laid out, there's one final piece we want to touch on, something maybe overlooked, who actually owns the biggest chunk of Opendoor. It might offer a different perspective on the long game. We'll get to that right after this. We've definitely covered a lot of ground today, digging deep into Opendoor. The complexities, the risks, they're significant, especially with the current housing market and those 2025 tariffs now in effect.
Absolutely. It's not a simple story. There are potential positives, but the headwinds and uncertainties are substantial. We really hope this discussion gives you, our listener, a solid foundation for your own thinking and research.
And now for that final thought we teased. Who's the single biggest institutional owner of Opendoor? Holding nearly 12% of the company. It's the Vanguard Group.
Vanguard, the indexing giant.
Exactly. So it raises an interesting question, doesn't it? When a massive index fund manager holds such a large slice of a company in a sector as volatile and frankly unproven as iBuying, what did that signify?
Is it just noise, part of holding the entire market through index funds? Or does Vanguard's significant position, even if largely passive, maybe hint at some underlying long-term belief in the technology, the potential disruption Opendoor represents, even if the path is rocky right now?
Something to mull over, definitely. Does the structure of ownership itself tell us something about the long-term possibilities?
It's a fascinating angle to consider, adding another layer to the whole picture.
For more deep dives like this, packed with data and analysis, make sure you subscribe to the Stock Analytics AI YouTube channel.
And just a quick reminder, everything we've discussed today is based on information available as of May 8th, 2025. It reflects our interpretation and synthesis of that data.
Critically, this is for informational purposes only. It is absolutely not financial advice. You should always do your own thorough research and understand all the risks before making any investment decisions.
And we should also mention that AI tools were used to help us research and summarize the information we discussed today, but the final analysis, the conclusions, the conversation, that's all human.